So yeah, my name's Ethan. I'm the co-founder and CEO of Allium. Today, I'm not going to talk about Allium at all. It's completely about these three people here. The topic of what we're going to talk about today, it's from data to insurance, how allocators can verify on-chain yield, right? So we have, okay, we'll start with Wojtek from Accountable here, right? And then we have Alex from Aidan. And we also have Christian from Relm Insurance. So I'll just let you guys introduce yourselves first, really quick.
So I'm Wojtek, as you said correctly, which is really a rare thing. I'm the co-founder of Accountable. What Accountable is at its core, it enables real-time financial verification of off-chain and on-chain data for institutions while preserving their secret sauce with them.
Cool. How about Christian?
My name is Christian Davies. I'm the Global Head of Distribution and Innovation for Relm Insurance. We are a fully licensed and regulated insurance company. We insure around 4,000 companies in over 40 countries around the world. Around 1,800 of those are Web3 native organizations.
And Alex?
Yes. Hi, Alex Krasnow. I lead DeFi insurance initiatives at Aidan. Aidan's the largest insurance brokerage globally, 80,000 employees across 170 plus countries.
I remember them from the Manchester United sponsor. I'm sadly a Man U fan. Okay, so let's go. Allocators want, I mean, we're seeing a lot of these different yield numbers, like double-digit APYs, fully on-chain, transparent. But sometimes transparency doesn't mean it's verified, right? So in this panel, I want to dig a little bit deeper into how we can go from data to something allocators can work on. And I think, Wojtek, I think you have something to add there as well.
Yeah, so people just assume that if something is wrapped in an on-chain token, then it's transparent, very far from reality. Basically, majority of these tokens represent some sort of off-chain activity. These are usually all unregulated hedge funds that are running them, and that they are promising to all of us that they're gonna generate some returns with our money. In reality, right, it's even less safe than unsecured lending, at least in my view. With unsecured lending, you at least get a paper called master loan agreement that sort of guides people that your principal is expected to be returned at the end of the loan. With all of these not so stable yield-bearing stable coins, as I like to call them, that's quite the opposite, right? Like they make money, they lose money, and you have nothing on them. So long story short, just because something is on-chain doesn't mean it's safe, doesn't mean it's transparent. It's just this token that we hope represents some sort of value is there. But the value, it's usually in the old world, in the off-chain world, hidden behind exchanges, custodians, brokerage accounts, and basically black boxes. So what Accountable enables these people that, of course, want to provide transparency is to prove that you have the money, that you're running the strategy, whatever that strategy is, and you don't need to show even to Accountable your API keys, your secret sauce of your operation. We give you means to prove it yourself, and you can share it publicly, privately, keep it for yourself, right? These are the options.
Yeah, thank you for sharing. So I know Accountable, you focus a lot of the proof of reserves, proof of solvency, right? I will flip it to Kristen and Alex, right? So how much of that data, on-chain data, is useful? If not, what is the data you actually care about, and for you to underwrite your policies, and what your buyers also care about?
I mean, 6 years ago, Moad, who's with the BMA, who's our home regulator, with the idea of setting up Relm Insurance of, by the way, guys, we have absolutely no data and we have absolutely no reinsurance, so we're going to take this all entirely net on our own balance sheet. We built our own data sets. We've got around 97,000 data points now. We've seen over 18,000 submissions globally. We've gone through bear markets, bull markets, winters, summers, winters, summers, winters, summers.
How many winters?
I mean, well, 6 years of them, right?
How many is that?
Is it 2? Is it 3? I
Too
don't know.
many.
I feel like there's too many already. And so the data, both on-chain and off-chain, the fundamental interesting thing about insurance is I can ask any question I want. And if someone wants insurance, they have to answer it. It is, if you answer it incorrectly, if you decide to lie about it, it's fraud. The fundamental basics of an insurance policy is honesty and what is the representation and what you warrant on your piece of paper when you submit your information to me. And if you don't, it's fraudulent, I don't pay out. So we use a lot of on-chain data, but we have insured the largest crypto companies in the world for over 6 years. And I have more understanding and more information of these massive private centralized exchanges with all of the different names. I'm not going to talk about who our clients are, but I can imagine you can guess. I have their financials. I have their audited accounts. I have more data than any venture fund or anyone is ever going to. If you imagine putting that on chain, that's what everybody would love to see. But we get that exposure and we get that access.
And so from your 97,000 data points, right, I'm kind of curious to know how many of them do you have to pay out?
Yeah, so I mean, we've handled in excess of 400 claims just in crypto and Web3 space.
Wow.
So you can Google Relm. It's public knowledge. We insured FTX West Relmshires, which was the US entity. We made the decision to insure them because of the regulatory status that they had. It was one-to-one collateralized. So yeah, we've handled quite a few claims, and we've paid out quite a few claims as well. But people have to understand, like, it's an insurance contract. It is a contract. There is we will do X if you do Y. We've had some weird claims where people think it's okay to try and claim for their dog's pet insurance on their directors and officers. Needless to say, we do tend to, decline those ones. Yeah.
What was the most egregious thing that got in the way of slip through for you?
Nothing slips through.
Nothing slips
yeah,
through.
so we have an entire in-house claims team that
Makes
manages
sense.
all of these claims. So again, we are a carrier. We are the judge, the jury, and the executioner. We are the arbiter of the claims. Everything is handled in-house because we have the knowledge, right?
And then, switching gears a bit, so I understand you work with Aidan and Alex as well. So, explain to me, Alex, you want to share, how you work with Relm Insurance and, what is your take on the data as well?
Yeah, a previous panel was talking about homeowners insurance. When you think about homeowners, we have 300 years of actuarial data. Where you're based, we know what you're going to pay. When it comes to DeFi, where we have 5 years maximum, a little bit of a different structure. And so, one of the reasons Relm has been so successful is deep technical understanding of the underlying technology, obviously the underwriting data that they need. Insuring DeFi is a lot different than insuring homeowners, as you could imagine.
Why? Why is it different?
Yeah,
in simple terms.
Today, our data is what's gone wrong. What are the risk controls that have led to losses in the past? And that's what we're learning from. So it's, again, we have 5 years. We have too many losses, but enough to have some level of understanding today of what needs to be insured, of what risk controls need to be mandated, and that will evolve over the next few years.
Okay, thanks for sharing. And are there any, so when you issue like an insurance, underwrite insurance policy, right, are there any unpriced risks right now? I know you mentioned it's a contract, but are there factors that people are not thinking about, right, on both sides of the marketplace as well?
Yeah.
What could be done better, basically? Yeah.
Fundamentally, when you look at, again, insurance, 360-year-old industry, it started off with 2 guys gambling as to whether or not a ship was going to come back across the Atlantic. It is incredibly educated, incredibly data-led gambling. That is what insurance is. That's the fundamental basics is how it started.
Which year did it start?
360 years ago.
360
I can't know.
years ago.
It was like
okay.
the 1700s or the 1800s or something. But the only thing you cannot insure is the upside or the downside of a trade, right? That's financial guarantee. It's against the fundamentals of insurance. You can insure anything else if you find someone who's willing to A, price it, and B, willing to look to pay out that loss. So, Alex and I worked together it was at the time the world's first full DeFi insurance policy, covering for a variety of different vault and curator risk. And the premium is absolutely, it's enormous, because when you look at who is actually holding the risk, if you're a hedge fund, you're then putting something to a curator to a lending protocol in a vault, you're 3 to 4 steps removed from actually being able to monitor and govern that risk. The difference is I've been insuring the protocol for 4 years. I've been insuring the vault for 4 years, the curator for 3 years. So I package all of that data together and say, okay, I can look at the entire stack, both off-chain and on-chain, and look to kind of try and price that.
And then that makes a lot. So that's this huge entire stack. And I'll switch it back to Wojtek, right? Like, are there any of these like data signals that you wish your buddies on the left and right are using, but are not using today as well, from your perspective?
No, but like the data is also changing so rapidly, right? Like, how could you price what happened to Aave this year? Like, you could, but probably your models are completely in a different state than it were, I know, a couple of days ago, right? And you every day get hit by a hack, and my Telegram channel with all of the hacks, it's absolutely exploding. So I don't think this is something like you can model out very well today. And what we provide, right, like, and I don't know insurance business like well enough, but if you can basically constantly verify, right, like what is the underlying of the strategy and how these things are evolving, basically, I would probably think that there is some value in it for yourself. And if you want to apply dynamic pricing of your premiums, then that sounds like absolutely critical, right? Like, what was there? And again, because you mentioned like that you have access to all of this financial information, I was getting financial statements from Alameda when I was lending to them back in the days at Maple Finance, and these statements were self-reported, basically. That's the reason why we built Accountable in the first place, because almost everything in this industry is self-reported. Otherwise, you are waiting for a year when you can be bankrupt 10 times in the meantime for audited financials. So what we are trying to provide is this different clock of updates with very high degree probability that this data is then real. So audits should stay, but maybe you can have a software like ours that continuously gives you some sort of information about it, and you can price your things differently. Before this panel, you told me that your shortest insurance period is 12 months, right? So that's also the difference. Maybe one day you will be insuring, I know, on a daily basis, right? Maybe that's how this will change.
Do you think the world will ever insure something on a daily basis? What does that world look like, right?
So Mo was talking on the previous panel around parametric insurance.
Yep.
And parametric insurance is basically if A happens, B pays. So you could have, on-chain data that's verifiable and constantly updating that could, change dynamic pricing. Something that would be quite interesting would be a hurricane scenario coming into Miami Beach, right? A lot of data.
We're not in hurricane season, are we?
Not, I don't think right
Not
now.
yet?
But if
No?
you imagine,
Okay.
if you can forecast and at least predict, you would see the premiums if people were trying to buy insurance policies last minute with on-chain data. The premiums would go up. You could have live adjustable models in real time. So that is some of these things that it very well could. The problem is, if you start to have institutions wanting variable pricing, you've then got to have someone on that institution who also is going to have to, mess around with the premiums, pay the premiums on a monthly, weekly, daily adjusted rate, and then it just becomes too much of a logistical and operational burden.
But don't you think smart contracts on the blockchains could be a solution for that?
It could be, but then you've got to tell every other institution who wants to pay that they have to, do spot contracts in the blockchain. And quite frankly, again, with our license, it's called an IIGB license, we are regulated to take digital assets on our balance sheet and use them for collateralization and solvency and a variety of other different things. That is already pretty mind-blowing for a TradFi. We've had premium payments for 6 years. I mean, Aon just did something quite cool, and some other brokers have done it, but you guys did with a stable coin. But talk about how hard that was.
Yeah, how was that? Please share more about that, what Kristen was talking about, Alex.
Yeah, absolutely. That was before my time at Aon, so I'm still catching up. I'm on my second month at Aon. Getting Treasury involved for anything digital assets is challenging, and we couldn't hold the crypto on our balance sheet. So this was in collaboration with Paxos and Coinbase, who are two of our clients. They were able to transfer that payment from stablecoin to fiat, and we accepted it. So we are as fast-moving and as involved in this industry as many institutions, or as most are, but even still, not something we're looking to do today is actually hold that on our balance sheets.
Do you think for that premium payments using stablecoins, right? Do you think this use case would get more traction over time as well?
We're hoping. We're definitely optimistic into its potential. I think we see a lot of cost benefits and speed benefits to it, but at the end of the day, every partner in these transactions need to be equipped to be able to pay and receive in stablecoins, and that's not set up yet. So we'll be ready when it is, but I think we're some time away from that being consistent.
Okay. So this is for the audience watching in the room. So for me, I'm not an insurance person. So you mentioned about the whole entire stack as well, right? What are the types of risk that an underwriter has to take, right? And you can share across all three of you. Is it at least for DeFi, right? Is it like a DAO shutting down or a DAO voting errantly, hacks? I mean, what are the types of risk, and how do we think about it? And what matters the most, that actually moves the needle?
Yeah, I think as it relates to DeFi and DeFi vaults, what's most prominent today would be, smart contract exploit, Oracle manipulation, protocol level exploit, and then market level exploit, failure, loss. Most of those are insurable. Market level is a little bit more challenging. That's what we're seeing for the most part today, and we're creating insurance products around that.
I see. And for these, so Kristen, you said you have a lot of past data. What happens if you launch a smart contract that has no past data, a new protocol? So how do you price that?
Again, right? It's everything. It's very highly educated gambling. So ultimately, the premium is 10, 12x what it might have been something where we've got 6 years of data set. Like, this is risk. We're willing to take the risk on our balance sheet, but we're going to charge for it. And it's a case of, kind of take it or leave it. But we're willing, and we have been here to support the industry in its constant growth as we launch into TradFi and TradFi's interest. We talk about like how allocators can verify and get comfortable with on-chain yield. It's the regulators as well, right? A lot of regulation has mandatory insurance requirements. Why? Because regulators use insurers as almost like a second guess as to, if they can get insurance and they ask all these questions, then we'll also look to regulate them as well. And just in case something happens, they do have insurance to kind of like fall back on. So we're seeing, the conversations we're having with different regulators all over the world around DeFi and the risks associated with it is also quite an interesting one.
Are the regulators mandating the insurance as well?
Yeah, so MiCA or MiCA, or however you want to call it, they have an insurance framework where you have to have certain insurances to get your license. VARA as well launched mandatory insurance requirements. I believe the BMA also has mandatory insurance requirements for any of their VASPs and CASPs. So it's very much part of of that.
And something I'll add to Christian's first point around premium. One of the challenges in this space that we're addressing is consensus around risk controls for DeFi and for vaults. And so in Christian's example, if a protocol came to them with none of those risk controls in place, couldn't tell their story, you're going to see that premium being astronomically high, oftentimes not financially feasible based on the yield that they're receiving. If we could come in and say, on top of these 2+ audits, we have this real-time wallet monitor. We're relying on multiple oracles within a vault to mitigate the likelihood of an oracle manipulation, oracle loss. There are a lot of different of those triggers that you can put in place, even if you don't have that background, that maybe won't, cut the premium so drastically, but will have an impact on, how the carriers look at you and then how institutions look on you. So something we're actively looking in is a role in playing the consultative role, in a sense of being able to advise these DeFi players. This is what carriers are looking for, and this is how we can get you insurance ready.
We've got loads, loads of the, and when when I talk about TradFi, I'm not talking about like crypto TradFi. I'm talking like TradFi, big listed multinational, chunky hedge funds, banks and stuff, and they're coming to us, asking us around DeFi because they're having conversations with different lending protocols, going, oh, so what do you know about these guys and how do you assess their risk and do you insure them? It's part of the conversation. Because with what we're trying to do and offer insurances, they're like, well, maybe if I start to allocate a little bit to Aave and a little bit to Morpho and a little bit to here in this vault, and you've got some insurance coverage on there, then maybe we kind of like cover our asses if something goes wrong with some of our clients' funds, just as we dip our toes into decentralized finance, because that conversation is here. And it is, incredibly important to get the likes of the BlackRocks, the Blackstones, and people and they are doing it, and they're asking us how.
Do you think they're willing to pay the huge premiums today, or would they get a much better premium?
So, they're allocating into the different lending protocols, right? Depending on which lending protocol they're looking at. It might very well be a large premium for them, and they ultimately would maybe say, well, why is it so high? And we go, we personally don't believe they have any of these applicable risk metrics, risk controls in place.
Actually, speaking about risk metrics, I know we don't have our friend from Gauntlet over here. We just chatted a little bit about Gauntlet as well. What are these risk metrics you think that would make the banks, yourselves, more comfortable to underwrite these policies?
I mean, the biggest thing that we have at the moment is looping, right? So that's something that we're really trying to get our heads around and how we track that from a risk perspective.
Okay.
Just because.
Could you explain looping to the whole audience here?
Yeah. So looping is when we were talking about liquid staking earlier. It's you put an asset into a vault, you get a token representation. You can use that token representation to put it into another vault. You then get a representation of that one. You can put that into another vault. So you're compounding your yield on top of each other. So you end up by having an enormous potential house of cards that can fall down. You get a massive bad debt problem that could have been triggered by an Oracle, manipulation. That's then not a $1 million loss to Relm. That's a $5 million.
Yep.
That's a 20. That's a $100 million loss. Bam, overnight. So you're just compounding that risk. So we're trying to figure out how we can track and trace looping to make it, insurable. Or we turn around and go, if you're looping, we're not covering it.
Or if you're looping, it's exponentially more expensive. I mean, one of the challenges that we've faced when it comes to insuring DeFi, lending, staking, whatever it may be, is we're obviously competing with the yield.
Yep.
So we need to put an effective program in place that isn't cutting so far and that is not financially feasible. Now, if you're looping and getting this, 30% yield, no idea where it's coming from, maybe we could have a different conversation on, the premium rates. It's challenging. I think, something I'd add to what he mentioned is your risk controls can be as institutional as possible. If your partners are not, your risk controls are not. And so that is the challenge, is every single partner, every flow of funds, every component, and every transaction needs to have that same standard or hold themselves to that same standard, or even if you're doing it.
One question from my side. So let's say somebody indeed allows some sort of vault token as collateral on Morpho, and this party is basically a curator that is supposed to be doing underwriting, whether this is the collateral that they want to accept. So when you're insuring something like that, are you relying on their due diligence at all, or you're just looking at it holistically from the perspective of the outsider, basically?
So if we're being asked to insure a specific curator, we would have gone through everything that they're doing from their own risk control metrics. So we would be like, well, what are you doing? How are you doing it? How are you underwriting? I'm underwriting the underwriter.
For each asset, like that they allow as collateral, or more like holistically on them as what are their methods?
So we do both, right? So
that takes a lot of time. Probably.
It absolutely takes a lot of time. Insurance is a bit slow. Well, that's a lie. It's incredibly slow. We like to see ourselves very much at the forefront and trying to work and move and adapt as fast as the industry as possible. But we get to ask these questions we build our own data sets. Ultimately, we should get to a point where we're either able to work with the likes of Alex and say, these are the mandatory requirements that you have to roll out, and these are the types of costs that you're going to look at. Because the more we learn from the industry, the better everyone is going to be supported.
Cool. So one quick lightning question, right? So let's say I'm a family office. I have $500 million in AUM, and I want to allocate 10% of that to on-chain yield. Like, how should I think about it? And each of you can just mention one factor to think about.
From the insurance standpoint, I think what's important to us is what are you looking to protect? What are your goals? If slashing, if it's a staking vault, if slashing is your primary goal, we can put a slashing policy in place. If it's lending and your main concern is the Oracle versus the smart contract, we can put those policies in place. So obviously, I look at everything with the insurance lens to it. We would want to know, as Christian said, your due diligence to choosing the protocols, the assets, and potentially the curators that you decide to allocate into, and then we would underwrite based off that, and we would do our own individually after the fact to see kind of what they missed or maybe how we look at it a little bit differently.
Okay, Wojtek?
Yeah. So again, it will be quite obvious, but what I said in the beginning, right? What are you investing in? Majority of opportunities that we see today that are being tokenized are off-chain opportunities. I know we did with Galaxy a tokenized CLO, right? These are hundreds of over-collateralized loans that are bundled into one thing, and we gave them means to prove what is it that people are buying in real time. I think an institutional investor wouldn't settle for a PDF self-reported once a month from some random party claiming that they have all of these loans and this is more or less the average collateral level of those, right? So
Yep.
I think more and more we're gonna see people moving to verifiable yield opportunities, as we call it, and just APY headline that it's usually self-reported and basically counting on a curate.
What should I be careful if I see 12% USD1 APY? What should I think about there?
Where is it coming from, right? And what's packed in that yield, right? And usually you cannot even see it, and that's what we are trying to change it. Then you let the curators do their due diligence, and arguably sometimes there is not much due diligence to be done, right? And it's very hard to say. These are all names. I know, back in the days when I was, again, lending on Maple Finance, we lent to Wintermute, our largest loan ever, $40 million. 3 days after, Yevgeny, founder of Wintermute, calling in the middle of the night, we got hacked, 160 million overnight, right? And then, just because somebody is called Wintermute, that doesn't mean anything. They can be hacked like anybody else. Reputation comes and goes. So then he's telling you, don't recall the loan. We are fine. We will survive. But you have zero data. You have a paper that came 1 month ago that was self-reported claiming they have equity that will backstop that, right? So that's what I mean, right? If you cannot verify, don't trust. So
that's really interesting, right? Because you say, well, they have a piece of paper, it's self-reported. I could have all of their financial statements. If they buy directors and officers insurances, that is, based fundamentally on what they have reported to buy an insurance product that helps, any of the financial costs and the legal costs associated with potential bankruptcy.
But the market maker never will have audited financials on a monthly basis. That just doesn't exist. It needs to be self-reported by nature.
Absolutely. But then they buy an insurance policy, which is D&O, which protects them or any potential bankruptcy with all the legal costs for the directors and the officers. So one of the questions that can asked are, do you have D&O insurance? Because if you have, they've probably gone through a pretty scrutiny, a very thorough look and deep dive by an insurance company. But I agree with you. I think I've also actually just had an idea of how we can work together. So we'll have a discussion about this after. But
because this paper changes overnight, right? A second ago they had a 160 million hole, right? That's the thing, that these things are very static, and even if they reported the full thing, right? This changed overnight. Their insurance policy should skyrocket 10 times, right? And you don't know about it. So that's, I think, where we can,
Yeah, no, absolutely, yeah, 100%. I mean, from our perspective, if someone had $500 million and looking to apply, allocate it to DeFi, I would say just go to Relm. The reason I say that is because, again, because of our license, we have the ability to build ILSs, which is an insurance. It's an insurance mechanism. It's an insurance-linked security, and with our license, we're able to collateralize those entirely in digital assets. So you can take a spread of underlying insurance contracts and reinsurance contracts. This is full-blown regulated TradFi, provisions, but entirely collateralized in crypto, and the yields can be up to around 40%. But Duke was talking about duration earlier, but the duration of these contracts are 12 months. These are not like super liquid, which is what the crypto space has always been about. So
no looping, unfortunately.
no looping, nope.
And in that same scenario, I'd say come to Aeon, and we'll figure it out from there.
Figure it out with us.
Maybe, we'll see.
Awesome. So I think with that, we can conclude this session, this last and final session. So thank you, everybody who's listening, and I think we can go grab a drink at the happy hour. Thanks, guys.
Awesome.
Thank you.
Yeah.